enjoying your meal, I'd also like to welcome for a very brief lecture on finance and legacy planning, Mr. Niyi Adeleye. Please put your hands together for Mr. Niyi.
Thank you. Good evening, ladies and gentlemen. Just wanted to talk to you about finance and legacy planning. Some of us are young and others are old, but it's never too late to plan or to start planning. I think the context is that there's a lot that we need to start preparing for as we move towards the next 40 years of our lives. Okay, next slide, please. Just to give you a context and context of the information I'm giving you. I work for Standard Bank Group, the biggest bank in Africa, about $130 billion in total assets, market cap of about $14 billion, and we have branches all over the world. We are affiliated to the biggest bank in the world, ICBC of China, with about 50 million customers, which is the size of a country. Next slide, please. I wanted to start with a quote from Robert Kiyosaki. If you do not know how to care for money, money will stay away from you. The hope is that I can give you some tips, probably stuff you already know, but maybe give it to you from another perspective and hope that it would resonate with you. Next slide. The first thing, just wanted to highlight a couple of steps about financial management. And the first thing is about looking at your income. You need to know what your sources are, how often it comes, and what the patterns are. There's income that you have that comes in bulk quantums. There's stuff that you have that is irregular. The regularity of it, the patterns that it comes, has a clear, it should have a direct impact on how you use it and how you spend it. The second thing that I wanted to highlight is on savings. Most people always think of savings as what you have left over after you've spent on what your needs are. But financial planning means that you treat your savings as your first appropriation. That's the first thing you remove from your income. And it's recommended that it's at least 10%. As your income increases, it goes higher. The theory is that if your income is, if you earn 10% less than what you earn, your lifestyle will not change materially. Then the next thing that you do is budgeting. It helps you to set your priorities. It instills discipline in terms of your spending pattern, and then helps you to manage your cash flows. The next point under financial management is debt. We don't have so much of a debt burden from a Nigerian perspective, but it's growing. Credit cards, personal loans, and so on. But what you should use debt for as a principle is for asset accumulation, for acquiring assets, less for consumption. You should also keep within your affordability limits. People set that threshold at about 33%, and have a management plan for your debt. How long do I want to have it for? How do I plan to repay it? Then investments. The idea is to make your capital grow, acquire assets that have underlying long-term value, and set investment targets within the horizon that you have. And finally, have someone that you can always speak to about financial issues. The richer you get, the more you can afford to pay for it. But if you can't, you can always find someone to talk to give you guidance and direction. Next slide. Just to show the relationship between income and wealth. Income is what you earn or what you make for goods and services you offer. Wealth is what you accumulate. There's a symbiotic relationship between the two. The more wealth you have, the more income sources you have. Some people recommend that you should have, as you grow older, you should have possibly about 8 diverse sources of income. It's not always possible, but the more you have, the better. Whether it's dividends, whether it's rental income, whether it's interest income from other sources. Next slide. A couple of investment options, stuff that people know already. Gold, in terms of gold bullion and investments, funds, mutual funds, money market funds, stocks, not a very good idea in Nigeria at the moment, but I mean, we're looking at it from a global context. Real estate, deposits, currency. From a Nigeria perspective, belong on other currencies. Don't just have naira. Have dollars, have pounds, whatever else, and bonds. What you have available in your market or in a market and in any market is a function of the depth of that market and the geography that we are in. So in the US or in the UK, you have a lot more options. In Nigeria, you have perhaps a bit more limited options. Next slide. From a financial management perspective, a couple of things to consider. Your time horizon. The longer you have, the greater you can tolerate your risk. You can tolerate risk. If you lose money now, you can make it back. From a tax perspective, think about tax implication on what your investments are, what you do with your income. In Nigeria, for example, and in some other sort of countries, your voluntary pension fund, your voluntary pension contribution is a tax deductible element, which gives you some advantage in tax, and also your mortgage. So in some cases, it makes sense for you to take a mortgage, even if you don't need the funding. Then diversification. If you think about the geography where people from Nigeria living abroad, where Nigerians that have investments in other places, think about investing in different geographies so that it diversifies your risks. But if you don't know the market, don't invest in it. Then risk appetite. Obviously, age has an impact on that. Then investment objectives, focus on long-term sustainable increase rather than just quick turnarounds. Next slide. Just a couple of things to note. Save early, save often, save automatically. Just as principles of finance or financial management. Monitor the big picture, your cash, your credit, your savings, investments, and your progress. Minimize irrational, unconscious, and impulsive spending. Avoid sloppy money mistakes. Save for the rainy day. Take good debt and minimize bad debt. Build your credit worthiness. Set goals, make wishes, enjoy life, know where you stand. Evolve from being a saver to an investor. Take advantage of your youth and compounding. I like to use that example. If you raise 0.9 to the power of 72, you get less than what you started with. But if you have just over 1 and you grow it exponentially, it doubles over time. That's the power of compounding. Next slide. Just talk a little bit about legacy planning. Legacy planning is about legally structuring your future dispositions to allow you to transfer it to your family. You can have multiple plans. Why do you do it? In some cases, for tax avoidance. Tax avoidance is not illegal. Tax evasion is illegal. Tax avoidance is working within the confines of the law and minimizing your tax impact. To minimize creditor claims on your assets and to protect your family wealth. Why is it important? I mean, I'm sure most of us want to leave something for our kids and our children's children. So it allows you to have a platform to transit wealth from one to another. For education as well, it's getting more and more expensive to educate our kids. So having a plan about how you're going to do that makes some sense. And also for medical care, and I guess that links to what Salaka was talking about earlier. Who should do it? When should you do it? Do it now. You don't have to be thinking of death to think about legacy planning. And who should do it? Everyone. Everyone. It's in any economy actually. If there's a transition without adequate legacy planning, your family will find it increasingly difficult to access whatever wealth that you have for them. Next slide. From a Nigeria perspective, a couple of options. You have joint accounts, inter vivo gifts, pension and retirement plans, limited liability companies, trust and will. Joint accounts, inter vivo accounts, and pension funds can only transfer a single asset type. That's really cash in the bank, or a specific gift that you give, or your pension plan. But the other three, a company, a trust, and a will, allows you to transfer multiple asset types. From a Nigeria perspective, the simplest one to implement is an SPV, a limited liability company, where the parents, the father, the mother, the kids are shareholders of the same company, and that company is used to acquire assets for the family. Your house, your shares, your investment in other companies, your investment in shares, all of them are done through that company. You can set up subsidiary companies to own different types of assets if you want to make it more complicated. Or, well, I mean, if you want to make it more streamlined. But either way, if in a loss or transition, it's easy to turn around. For wills, that's the next easiest thing to do as well. It's about having a document that itemizes your assets, consolidates it in one location, and is comprehensive to everything that you do, and is transferred at the point of death. Next slide. For trusts work slightly like wills, but it can be activated while you're alive. But the only challenge with trust is that the cost of setting it up can be quite high. So unless you have significant assets, it becomes not worthwhile to actually pursue that route. From a US and UK perspective, the same sort of chain of what you can do. You can have your joint accounts, your inter vivo gifts. In the US, you can have what you call a pay on death account. So that account is set up in such a way that at the point of death, the content of the account is transferred to a named beneficiary, for those of you that live in the US. Then pension and retirement schemes as well. In the UK and some of the European countries, the pension schemes terminate at the point of death. So there's nothing to transfer there. So it's something to be mindful about. Then life insurance arrangements, trust, wills, and foundations. Foundations more in the UK and in the US. For guys that live in the US, something to note is a new regulation from the United States, FATCA. FATCA means that if you have assets in any country, as long as you're a US citizen, the American government can track it and they can tax it. So if you open an account in Nigeria as a US citizen, any of the banks in Nigeria are required to annually report your income or the contents of your account to the US government. So they will come after you. So if you have those accounts and you're a US citizen, be very careful. You might need some more advanced tax structuring to make that make sense. Final slide. Building wealth is a process of managing risk, not ignoring it. It's time, it takes planning, and I think we can all get it done. Thank you.
Thank you very much. For Mr. Niyi Adeleye.